You know, Scotiabank is one of Canada's biggest banks, a real giant in the industry. But if you're an investor, you've probably noticed it's been a puzzle for a long time. It's this huge, stable bank that's always seemed to trade at a discount compared to its peers. So today, we're going to dig into exactly why that is and the bold new plan they put in place to try and change the story. All right, so let's get right to the heart of it. This is the big question, right? You're an investor, you're looking at the big Canadian banks, and Scotiabank, its stock ticker is BNS, it just always seems to be the one that's a little bit cheaper. Why? What's been holding this stock back for so long? So, the answer. It's not like the bank has a bad reputation or anything like that. The real key to this whole puzzle is hidden deep inside the bank's own structure. It really comes down to a tale of two very different businesses, their Canadian operations, and then everything they do internationally. And wow, this chart just lays it all out, clear as day. I mean, look at this, the Canadian banking side. It's an absolute beast, generating a return on equity of nearly 30%. That is fantastic. But then you look at the international business, and it's less than half of that. So you have this super profitable engine at home that's basically being weighed down by lower returns from abroad. That's the drag on performance, right there. You know, for years, this was Scotiabank's whole identity. They loved being Canada's most international bank. It was their thing, it set them apart. But as those numbers just showed us, that global footprint came with a pretty hefty price tag in terms of lower overall profit. And eventually, the board just had to look at the numbers and say, okay, something's got to give, we need a new plan. And that's exactly what happened. A new CEO, Scott Thompson, came on board. And he didn't just come in to keep things steady. He was brought in with a really clear mission: fix this profitability problem once and for all. And to do that, he laid out a whole new blueprint for the bank's future. And this slide just perfectly captures that change in thinking. It's like they're throwing out the old, complicated world map, you know, the one with pins stuck all over Latin America and the Caribbean, and they're swapping it for a new, much cleaner blueprint that is totally zeroed in on a North American corridor. We're talking Canada, the US, and Mexico. That's the new focus. And the new leadership, they are not being shy about this at all. The new CEO is saying it right out loud. The goal is simple: improve profitability. They're going to stop putting money in places where it doesn't work as hard and start focusing it where they can get the kind of returns that shareholders and the market expect. It's all about closing that performance gap with the other big banks. Okay, so a new strategy sounds great, right? But as an investor, you're always wondering, is this just a bunch of talk and some slick slides? Well, the new team knew they had to prove they were serious, and they made a really big move right out of the gate. And here it is. They went out and acquired a nearly 15% stake in KeyCorp. Now, KeyCorp is a large and well-established regional bank in the United States. This was not some tiny little investment. We're talking a multi-billion-dollar move that basically shouted to the market, we are serious about the U.S. And if you're an investor, you have to admit, this is a pretty smart way to do it. Think about it. Instead of trying to buy a whole bank, which is incredibly complicated and risky, they buy a big piece. This gets their capital working in the U.S. market right away, it starts generating earnings, and it gives them what they call future optionality. Basically, it's a foothold. They can learn the market, build a partnership, and maybe do more later. It's a much safer first step. All right, so we've got the strategy. We've got the first big move. Now let's look at how this all shakes out in the numbers that you, as an investor, actually care about when you're looking at the stock. This table pretty much sums up the entire investment case right now. See that price-to-book ratio for BNS? It's lower than the others. And why? Well, look right below it at the return on equity. It's also lower. The market is basically saying, you're less profitable, so we'll pay less for your stock. But, and this is a big but, look at that dividend yield. You get paid more to wait. It's one of the best yields of the whole group. That's the trade-off. And we're not talking about some new, risky, high yield either. This dividend is rock solid. I mean, Scotiabank has paid a dividend to its shareholders every single year since 1833. Just let that sink in for a second. For anyone who invests for income, that is an incredible track record. It's the core of the buy and hold argument here. You get that steady income while you wait for the new growth strategy to kick in.
Okay, but we have to be realistic here. No investment, especially a turnaround story like this one, is a sure thing. A great plan is one thing, but making it happen is another. So let's talk about the risks, because there are definitely some big ones to keep an eye on.
So there are really three main things to worry about. First, execution risk. That's the big one. Can the new management team actually pull this off? Second, credit risk. You know, Canadian consumers are carrying a lot of debt, especially tied to the housing market. That's a risk for any Canadian bank. And third, they do still have that international business, and those markets in Latin America can be pretty volatile, both economically and politically. So, if this story interests you, how do you know if the plan is actually working? What should you be looking for in their quarterly reports? Well, think of this next slide as your personal investor dashboard.
These are the 4 key things you got to track. First, that international ROE. Is that number starting to tick up? That's proof the cleanup is working. Second, are they still growing their main customer base back in Canada? You don't want the core business to suffer. Third, look at their provisions for credit losses, or PCLs. Are they keeping bad loans in check? And finally, operating leverage. Plain and simple, are the revenues growing faster than their expenses? If you see green lights on this dashboard, it means the blueprint is coming to life.
Which brings us right back to the beginning, to the central question for any investor looking at this stock. What you have with Scotiabank is this really attractive high-yield dividend that pays you while you wait, and you have the potential for the stock to go up if this new North American blueprint really succeeds. They have a plan to solve the puzzle. The billion-dollar question is, do you believe in the blueprint?